As of next, as many of you might have noticed, that institutions is a great element and in HashKey ecosystem. So next, we're going to welcome a few of the key leaders from the institutions that we're working very closely with. Henry from DigiFT is going to lead the panel with Kelly from Elwood, Matt from FalconX, and Mike, the CEO.
Good afternoon. Thank you for joining this panel, and thank you for HashKey for organizing this excellent event. This panel, we have the topic about look in the future and what will be the enablers for hopefully the next Bullrun to coming early. To start with, can I invite my dear panelists to give a very quick introduction about yourself and also the company you are representing.
Hi, everybody. My name is Kelly Pettersen. I'm a director on the commercial side of the business over at a company called Elwood Technologies. Just a little bit about myself. I've been in crypto now since 2018. I've worked for a number of different size firms. Prior to Elwood, I was on the Coinbase institutional side. And I'm based in London, working with a number of different hedge funds, asset managers, banks, and spending a lot of time day to day with clients in the market. Pleasure to be here.
Hello, everyone. My name is Mike Belshe. I am co-founder CEO of BitGo. We are a wallet platform and custodial services provider in the industry. Been doing this for over a decade now. So look, we got another decade to go. Hope you guys are buckled in and ready to go.
Hi, everyone. My name is Ian, and I'm part of the founding team at Merkle Science, where today I'm the product lead for our forensics tool. Merkle Science is a blockchain infrastructure provider where we are building software solutions to drive the next generation of Web3 adoption. And before I joined Merkle Science, I started my career as a capital markets lawyer. So today, really trying to take that experience and translating it into useful solutions to help our clients.
Thanks. My name's Matt Long. I'm the general manager in APAC for FalconX. We're a global prime broker servicing institutions. Been involved in crypto for around 5 years, and prior to joining FalconX, was involved in building and running a number of regulated crypto businesses across the region.
Thank you for all your introductions. We have these panelists, not only the experts in the area, but also very active, influential in the market to give in the opinions. By introduction, I'm Henry Zhang. I'm the founder and the CEO of DigiFT. DigiFT is an exchange. It is an exchange for security tokens. We're using DeFi technology. We believe in that. So it's a DEX. And we are regulated. So it's a regulated DEX for security tokens. We are regulated in Singapore by MAS. Okay, I have prepared some couple questions to discuss with in our panel. First, maybe let's talk about compliance. Talk about the regulation and the compliance. We see the technology blockchain technology has been evolving very fast. How do you see this being compliant, and or in other words, the compliance playing the role while we're developing the innovative solutions, especially for this kind of institutional adoption? How do you view this compliance as an encouragement, discouragement, or as an enabler, or as a barrier? I just open this question freely, so anyone want to pick up this question to start with?
Well, I think everybody said the word "we're regulated" in our introductions. So that sort of answers the question. Obviously, the regulators have taken a very unique view, but not just the regulators. Like the regulators in every single country have taken a view, and they're kind of confused. But look, the regulatory landscape that we have for markets that we trade, whether it's talking about equities world, we're talking about derivatives, commodities, et cetera, like it took decades to set the regulatory frameworks that we know today. And it was done at a time when there was zero technology to assist with it. In fact, you know, the first chairman of the SEC was JFK's father, Joe Kennedy. And why was he the first SEC chair? Because it turns out in the 20s he was really good at manipulating markets. He ran more pump and dump schemes and organized, you know, methods to make money than anybody. So they said, okay, who should we hire? We'll hire Joe. Joe goes and creates what we now know as the 1940s Act, and et cetera. All right. Anyway, it's going to take a while for regulators to sort out crypto. I did a talk at JP Morgan to executives there, probably 2016. And, you know, I'm a technologist. I don't have a financial background at all. I studied a little bit. We need market structure for sure. But I'm doing this presentation about securities markets and you know, CFTC markets and the various participants with brokers and custodians and clearinghouses and et cetera. You can see all these light bulbs going off in the audience. And afterwards, they complimented me. They really liked it. I'm like, come on, guys. You're JP Morgan. Why am I telling you how this works? And they said, you know, it's Bitcoin. It's crypto. It just seems like it's different. So number one answer is that we really do have a technological change. They don't really know how to address it. Regulators have the exact same problem. We shouldn't be surprised it can take a long time. The number two thing is, actually, the incumbents in our traditional financial systems, they don't help figure out what market structure should be. They just try to figure out how to go make money within what's already there. So these are not innovators. These are not systems designers. These are not the types of people that figure this out. And when you go to the regulatory staff, whether you're talking about legislative or regulatory, you're going to find the same thing. All right, so anyway, it's going to take a long time. It's going to take another 10 years at least. We're all regulated. We got to say that so that institutions will interface with us, but it's going to take a long time.
Yeah, look, I think to extend on what Mike said is, and on the final point is, for the large institutional pools of capital to actually access the markets that we're building into, they require consistent framework from a regulatory perspective. And I think, you know, we see regulators globally moving in similar directions, mostly. I can speak to the Asian experience more specifically, but, you know, generally the way that regulatory frameworks are evolving is positive in the right direction and aligned around ensuring, you know, protection of investors, you know, mitigating systemic risk, AML, CTF sort of mitigation of risks. So I think very consistently moving into the right directions and increasingly implementing new technologies to do that, be it around chain analytics or market surveillance or other mechanisms. So again, overall, I think it's, you know, again, speaking to the Asian component, very consistent, positive evolution of regulation and the frameworks that are coming into place.
Yeah, thank you both. And I think you have a very insightful views on that. I just give some of my personal views. One thing I think when we talk about this new technology coming up, especially when we apply these new technologies to in the financial industry, regulation is inevitable, and to a large extent is very needed. Otherwise, the whole community will pay other costs like investor protection, blah, blah, or some bad behaviors because the cost for doing bad things is too low. But on the other side it's a challenge. It is an inherent challenge because innovation is always ahead of regulation. Or in other words, regulation is always behind the innovations. So how these two things can synergize hand in hand is a challenge. So one side, we definitely need to work with regulators embracing regulations, but on the other side, we do hope regulators and the regulations can also evolve or progress in a positive way. In this regard, I would say currently, in many jurisdictions, it is a challenge because we're seeing regulators is more willing to give so-called the blacklist. You cannot do this, you cannot do that. But fewer, they give like a whitelist. She's saying you can do this, you can do that. That's why the market actually is a bit confused for the builders like most of us on the stage. We only be told you cannot do this, but we don't know what we can do, right? Or we can just do the things at the cost of penalties or others, which is not positive. So just my personal view. Now, okay, maybe we'll move on the topics along is when we say we're building for the next bull run. Of course, technology is a key enabler. It's so important. Then I would just invite your views about how do you think technology as an enabler for us to, as a building blocks, actually it's not only building blocks, but it's a fundamental things for us to build the next bull run. How do you think about the technology perspective? Anyone want to start with?
I think from a technology perspective, over the last number of years, there's been this huge Cambrian explosion of innovation, right? Between the internet, between blockchain technology, and various use cases that have been starting to be applied with blockchain technology and crypto coming through as a result, be it payments, be it tokenization, being just trading for speculative reasons. And I think really that's been driven a lot from a retail perspective. There's been a lot of interest from the retail market, a lot of flow coming in from the retail market with very specific niche use cases. But that has really resulted, I think, in fragmentation of the market as well. And from an institutional perspective, when I really think about technology and the enablement of that into potentially the next bull run, I think there's two kind of interesting sides to it, I think. I think one is that crypto can actually learn from, some of the real successes in TradFi. For example, on the institutional side, you have fixed APIs in TradFi. Crypto grew up with APIs that are more like REST APIs, WebSocket, et cetera, that maybe, aren't as intuitive in terms of messaging and the way that the system integrates, for example. Also, in terms of traditional finance and the traditional exchanges, you have very robust, rich, fast data. In crypto, all the exchanges, I guess, in traditional finance, they have their own servers, their physical servers. Everything is very driven in crypto by running in the cloud. And you have thousands or millions or hundreds of thousands retail users on these exchanges. And to actually kind of run in AWS or GCP with very small, tiny tick sizes and getting data delivered robustly and fastly has been a challenge to grow up the industry. And then on the other side of it, I think TradFi can potentially really learn from crypto on a few things. And in terms of areas like instant settlement, right? You do pre-funding in crypto, which may be a challenge in itself, but you can have instant settlement because everything's pre-funded. Whereas in TradFi, you have T1, T2, T+3 settlement times. So all in all, I think there's a number of different things we can look at that come both with the good and the bad from traditional finance and from crypto. And I think it's kind of accepting the good and accepting the bad and trying to grow up a little bit with the best of both worlds until potentially the challenges are deprecated. And if they're not, just trying to find a balance in between to try to enable the technology forward and converge a bit on the institutional side between both worlds. So that's kind of how I was thinking about it.
If I could chime in, I'd like to combine maybe an answer to both your questions. So first of all, I think compliance has come a very far way, right? When Merkle Science started back in 2018, one of the first products that we built was a cryptocurrency wallet and transaction monitoring tool. And the reason we started with that was because a lot of the perception in the market at that time was that crypto was untraceable, right? It was only used by criminals, right? And half the companies that we spoke to when we told them, hey, we do blockchain monitoring, none of them knew what it was, right? So back then, I think there was still a huge gap in everybody's knowledge and understanding about what the technology could do. And today we've come a long way, right? Today I think it's fairly accepted that if you want to be a regulated entity, you have to use some kind of on-chain monitoring solution. You have to use some kind of surveillance tool. And the regulators themselves are wising up to this, right? They themselves are starting to ask more sophisticated questions into how they can use the data provided by blockchain to do more active surveillance, more active enforcement. And as people start understanding the technology better, some of the initial barriers around AML concerns has started being addressed by the technology themselves. If we look at a lot of the stablecoin projects today released by enterprises, a lot of them have started building in compliance directly into the code, right? They have the ability for the issuer to freeze wallets, undo transactions. And I know for those blockchain maximalists here, this may not be very popular, but the unfortunate reality is if you want a financial system that's regulated, there are certain expectations that we have to comply to. And nowadays, people understand that we can build those controls into the technology, which has started making more enterprises more comfortable adopting it. And so today we see more institutions coming in and they have more sophisticated questions again. What kind of controls can we build into the technology so as to better manage and control the risk? And as the industry as a whole starts appreciating that this is a data-driven economy, people have started coming to us and asking us how they can start using the data in different ways, right? So just because we can monitor criminal activity, if you think about it, using the same technology, we can also monitor business investments. We can monitor how trades are being made. And so more institutions are now coming to us asking us for business insights. And so again, I think as people start appreciating the technology more, we'll find more and more use cases. And a lot of the initial concerns brought about by the technology today can also be answered by the technology itself. And so I'm very optimistic that we'll see a lot more innovative solutions and services being produced now that the technology has become more mature and there's a better understanding about the risk and possibilities.
So let me actually challenge the whole premise that like the next run is going to be ready for scale, and should it be? And to your point, talking about a little bit of recognizing what compliance and whatnot means. Look, if we settle for the status quo, that'll be the fastest way to get to a bull run at scale, and we will have right back to the exact same financial system that we have today. I'll give you a simple example back on the compliance point. The travel rule. It's been an enigma for all of crypto. We talked about it since 2013. A number of regulators are pushing for it. Some dates, they haven't been held very hard. It's going to come sooner or later. But do you need it? The largest recovery ever of funds, the Bitfinex funds, was done without any travel rule whatsoever because we have this thing called the blockchain, which gives transparency like we've never had before. Further, if we were to apply travel rule as known today, what we would be doing is we would be doxing everybody. So travel rule, if you need a little review, any two financial institutions sending money between each other must exchange information about the sender and the receiver. That means that the receiver of that money receives the identity of the sender, along with a Bitcoin address. So now you've got the full blockchain history of the guy that sent it to you. This was never the intent of the travel rule as designed under the old technology, because the old technology didn't have a blockchain. All right, so the fastest way to scale is to just repeat the same technology we had in the past, which is no longer relevant. Anyway, I hope everyone in this room fights to actually make sure that we build better technology than what we've had before.
Look, maybe one more different take on technology is almost at a more fundamental level. And if we think about the next, what are we called? Building for the next generation of institutions. So if I think about across this region, the amount of capital and wealth markets, okay, so big pools of institutional capital that the gatekeepers are effectively regulated banks, regulated wealth managers. You think about putting in a new piece of tech, try putting in a new piece of custody, digital asset custody into one of these big institutions. And there's a very fundamental couple of problems. Fundamental lack of domain inside those large regulated institutions about what digital asset technology is and its nuances, number one. Number two is plugging in new generation technology into institutions that might have 10, 20, 30 years tech debt and this old plumbing. So how you actually go about that process of implementing at the very basic core technology infrastructure level into these big regulated pools of capital is it's a non-trivial practical exercise, and also a non-trivial exercise from an outsourcing perspective. And they're real problems to solve as we grow.
Yeah, thank you for all your inputs. I would just add on thing is technology as an enabler, they are not only enabling the innovations from the commercial side. I think technology is also an enabler even for the regulators. As Mike, you mentioned, right, this travel rule from the every transaction, sender, receiver, all the things. It's big enabler to the regulators if they really want to investigate it or look into every step of the transaction. So that's a dream state for the regulator perspective, I would say. What do they want, right? Look at how the regulators regulating, supervising the traditional finance. I was in the traditional finance for a certain time. They're asking for reports, right? Every time they ask for a report, tell me what's going on. And they want immediately, as quick as possible, as detailed as possible. But no one can give them immediately. And also this report always incomplete, inaccurate. But with the technology, blockchain, for example, it is possible you give accurate, complete, and timeliness kind of reports, which is in the technology. Without the technology, the efficiency is much lower. So it is an enabler not only for the builders, but it's also an enabler for the regulators. So overall, it's very, very positive, but just how do we use it, right? Being a regulated exchange, we're also telling regulators, not because we say we want to do a decentralized exchange, you should only be scared. You should also be happy to a certain extent, because being a decentralized exchange, all the information is transparent, even we don't submit the report to you. We cannot hide, or very difficult to hide. So this is our view. Hope they can buy in this idea. But anyway, do you, anyone has any further inputs on the technology part? Because we have so many technology experts in this panel. Ian.
I will just say maybe one more thing on a point, which may not be that popular, but I think we have to recognize that as much as technology enables commercial applications, it enables the regulators, it does enable criminal activity as well. And we have seen an increase of people kind of taking advantage, I think, of certain platforms where I think today there isn't enough of a standard that a lot of these companies are being held to, which has led to a lot of these projects being exploited. And criminals are also increasingly turning to different applications of the technology to hide these misappropriated assets. So unpopular point of view, but I do want to point that out because I think as all businesses should be aware of the risk and take appropriate measures. Yeah.
Well, actually, the stats on that don't match up to what you just said. Your assertion was that the blockchains are used for more criminal behavior than other venues. But actually, Chainalysis does a review of this. Every year they publish it. It's not to say there's not bad actors. And yeah, there are a lot of people that are running without any type of compliance whatsoever, and that does cause some problems. But in general, the blockchains actually provide way better, way safer platforms that will have less fraudulent activity just by nature of being transparent. So, I don't know, I disagree, and I think we shouldn't let go of this, because if we just, quote unquote, enable the regulators to create the perfect surveillance state, we'll all stop using blockchain. So the whole point was we wanted to accelerate this thing, but if we just create a surveillance state, nobody's going to use it.
Thank you. Very valuable points. Okay, let's move on. Let's talk about institutional adoption. We all know that institutional participation is so important for to make something for real. So the question is very simple: is how is your view and how on the current status in terms of institutional participants for many things you are building and for the overall blockchain adoption we are in. So anyone want to talk about that?
I think overall, like when it comes to institutional adoption, we've gone through peaks and troughs over the last number of years. I think underlying, though, if you were to look at it over the course of the last 5 years or so, I think we're still on the up in terms of institutional adoption. Where Elwood comes at it, though, is we are a risk management, portfolio management, and execution management platform. So we work directly with a lot of traditional asset managers that might be spinning up crypto funds. We work with neobanks, crypto native hedge funds, macro hedge funds, et cetera. And we spend a lot of time with them thinking about their technology stack, how they can think about executing across the market and different venues and liquidity providers, how can they manage their risk, how can they scenario plan and understand their portfolio overall. And I think today, obviously in the last year, we've kind of gone through a number of different challenges as an industry. And I think today, looking at the market that we target, I'd say that there's two kind of slices of the client profile we're looking at. And one, from a fund perspective, is if crypto is basically a bit depressed and it's very related to maybe a rates market, when firms are risk on, rates are usually down, right? And vice versa. And I think a lot of the crypto funds out there today are struggling to raise capital. A lot of allocators are not ready to allocate fully into crypto. And I think that hurts a lot of the funds out there in terms of their AUM and their ability to spend and invest in infrastructure and invest in systems and tools. We're constantly pushing that for various reasons because we have saw kind of lack of risk management and other behaviors, challenge the industry. But that's kind of the one side of the market where I think a lot of these funds and getting the allocation and the investor capital has been very, very hard. I think on the other side, we are seeing a lot of firms as well, and I think this is the positive angle, which are very well capitalized in the market, and they're doubling down now. They're building, they're looking at their operational infrastructure, their architecture, what ecosystem providers, service providers, and they're really getting set up for hopefully rates to eventually come down a bit and the market to hopefully pick back up. And at that point in time, they'll be ready to, manage their risk better, execute across the market, and have a transparent view of their portfolio, and actually manage investor demand in terms of how they report on their strategies or on their fund performance.
All right, well, I think the use cases are already right here. They're right in front of us. And actually, we shouldn't get too anxious and think that we're done. Like, we need a really strong foundation of security at the bottom. We haven't fully figured that out. But the use case that we're driving for, whether it's store of value that's outside of the control of the federal governments, whether it's having assets that you can verify that are actually there, visible on chain, not rehypothecated, you know what the risk is. That's the use case. It's right there. We just got to keep building on this stuff. So I would encourage everybody, don't replicate the existing financial system. Continue to focus on transparency, risk reduction, the fundamentals, and we just got to keep building. We have too many failures because we haven't finished that. There's scalability issues we got to work on. But yeah, we're here. The current financial system has failed us enough.
I was, again, just going to add, I think in taking it back to first principles, the client's always right, yeah? And investors, institutions want digital assets on their balance sheet. They want exposure. And so it's up to folks like us to deliver in the right solutions within the right regulatory frameworks, yada, yada, yada. But at the end of the day, people want alpha. They want access to tokenized assets. This is pensions, institutions, sovereigns. They want this. This is not going away. So it's actually back to all the things that we're talking about, providing safe, secure solutions to enable that access. Because it's, again, I'm pretty sure we're all resolute in our belief that this technology is not going away. So it's actually just making sure that we're building as quickly as we can to meet that need.
Okay, I'd love to go on this discussion, but we have a limited time. Let me just jump to the last question. Everybody just can very quickly, 30 seconds, respond to that. It's about the forecast, about the future, but not 10 years forecast, which is easy, and not 1 year forecast, which is also easy. 3 years. So how's your view about if you forecast from now in 3 years, what the future will be, how the world will look like in the related to today's topic about we're building the next phase of no matter what called a Bullrun or the new phase of technology. 3 years.
I think the market would have picked up by then. I don't necessarily think we'd be in a bull market, but what I do think is that by then, DeFi and a lot of these decentralized applications would have a clear framework for them to operate, because I think a lot of the focus is on that right now. And once we solve that, I think we'll see a lot more institutional adoption on these platforms.
I was going to go back to price action. For me, price action drives everything. Allocation comes in when there's positive price action. If we're still at these levels in 3 years, well, we're all going to be doing something else, right? So, you know, I'm being a little facetious, but I think price action through next year, as we see different regulatory uncertainty lifted, that drives allocation, drives alpha, drives money back to markets, drives investment. 3 years, yeah, hopefully we're in better shape in markets, and that I think the DeFi point's a really, really good one. You know, when DeFi is unlocked from a regulatory perspective, it's going to drive an enormous amount more capital into markets.
I think just to add to that, Matt, I think in the short term leading up to the 3-year mark, we're starting to see, and price action has not changed, but we're starting to see, I think, some really big movers and shakers like double down on this industry. So I think it's important that we think about how this can kind of be more mass adopted as well. It's from an institutional perspective, but it's also from like, how do we actually get critical mass to start using, you know, these systems and tools and these platforms to really drive blockchain technology, crypto adoption, et cetera. And I think we have seen the likes of, you know, PayPal come out with the stable coin. We have seen some regulatory progress and potential case law being made out of the US from, you know, the likes of Ripple and others. Things are still developing there. We have obviously seen BlackRock as well move forward potentially with launching an ETF. BlackRock, you know, $8-9 trillion in assets under management. If you compare that to countries' GDP size behind the US and China, BlackRock is number 3. So if you look at that in terms of marketing and distribution and broader adoption, we still have challenges, I think, over the years to come as it's technology and we're building and everybody's figuring out as they go. But I think some of these underlying fundamental companies and corporations and big brands with big distribution, I think that helps as well continue to develop and accelerate the industry at large. So, you know, I think now the market hasn't been great, but underlying some of the core fundamentals are there, and we're continuing to see that grow. And I think long term, I'm really excited to continue to play in the space.
Okay, just real quick. We will have an ETF. All right, so that'll be there. We will have a lot more regulation. A whole bunch of crypto companies will be wiped out, kind of like the first phase of like the internet. They're all going to be gone. And then lastly, the traditional financial firms will have failed to actually start to embrace crypto into their firms. It might be a little bit, you know, Fidelity's will be an outlier, maybe BlackRock, asset manager, maybe they'll get in some, but for the most part, we're going to see a number of large crypto-first financial institutions starting to rival the sizes of today's financial institutions.
Thank you. That's a very specific forecast. Thank you very much. And let's conclude the panel discussion for now. Hope you also enjoyed the discussion. Thank you very much.